toughest. And, for me, what I started doing was I would use the team. I wouldn't call them a team because we're not under one umbrella, but I would say, yeah, me and my partners, because at that point I would legitimately, I had people that I was talking to, and we were telling each other, yeah, let's go find a deal. I wouldn't say me and my partners if you legitimately are not working with anybody. But if there's one person that you're working with that's either going to bring capital to the table, or they're going to do the asset management or whatever, they're underwriting deals with you, even if you don't have a deal, they're in my book, they're partners.
Yeah,
because you're working together.
That's true.
And so I use that a lot on broker calls. I say, yeah, me and my partners were looking in this area and so on. And in the beginning, I always got the question, well, where are they? What's your responsibility? Brokers are prickly sometimes when you first get to know them. But it did help to have the knowledge that it wasn't just some person, a singular entity roaming about the internet finding properties. It makes a big difference to know that you already have people in your corner, and certain people are responsible to raise the capital. You're responsible to do whatever you're doing, and so on.
It gives you a lot. I find it gives you a lot more confidence, right? Because so when you get asked, well, who does the asset management? They can't really ask you those questions. You don't. If you say, hey, I'm the money raiser, well, you know what? You've got an instant, out. Well, I don't do that part of the business. I'd love to help you, Mr. Broker, but I don't handle that part of it, right? And then, that's what I've kind of found, that you can just stay focused on one, and say, hey, that's my other partner.
Yeah. It wasn't asked yet. If someone else has a question, please interrupt me.
If somebody else does, we don't need to take up the time here.
But yeah, in the absence of a question, Daryl, when you spoke up, it reminded me of something, because I think we've talked about it before, Daryl, but on the investor side of things, I mentioned in our underwriting, and I didn't get to go through all the, where we added a bit of conservatism, why we added buffer here. I call it buffer, in my world. Why you could say why we mitigated certain risks, if you will. Yeah, there you go. So, we didn't get into all the mitigations that we put into that underwriting, but I think as an investor, it's and I'm speaking on the passive side, even the active side, because if you're going to partner with someone, I mean, you need to know how to look at their underwriting and figure out if they're blowing smoke, for lack of a better word. But, you need to look at it with that cautious mindset of, can they really do what they're saying they're going to do? And I've seen some opportunities come across my desk for, partnerships, or, hey, we've got this deal, what do you think, kind of exchanges. And, I would encourage even the passive investor, get into a little bit of underwriting, especially right now. Deals are hard to come by, and it's, it's sometimes you find different practices that may not align. That's probably the polite way of saying that. But sometimes you find different practices that may not align with your comfort level of how to mitigate risks. Yeah. And, one example is the market. Does the market really support the rent that you're going to ask? Just because there's 5 properties within a 25-mile radius that are getting $100 more a month, is the street that it's on and the demographic that this property's attracting, is that gonna be able to support that kind of rent bump? You could have a property across town do whatever it wants, but is that area where it's located really going to perform? And there's a lot of those kind of things that I've seen recently pop up, and some of it, whether it's intentional or not, I can't say, but it does draw a lot of question to, even on the passive side, for people looking on that side, or even the active investors that may not be so strong in the underwriting. There's those things that you can legitimately look at, and anyone can pull up, some rent comps and figure out, hey, is it reasonable what's being said? Because just because it's written down doesn't necessarily mean it's reasonable. And I see that being a lot of goodness in there that comes with practice, right? As you get more familiar with the market, as you get more familiar with, well, should expenses be,
So
Well,
what you're saying, Brady, is
you
don't take word for word what the broker's OM says as that's what the property is going to do, right? Is that what you're trying to tell me?
well, for the brokers, yes, and for the underwriter. So I
Yeah.
was speaking also and primarily about if it's not your deal, if you haven't done the underwriting on it, there's, at least be aware as much as you can, because I mean, I know, fortunately, or, some brokers are quite open, now with, discussing. And I mean, there's deals that are getting closed that even, these brokers see a lot of properties. And I've had, you know, a few over the last few weeks tell me, I don't know how they're going to make any money on the property, but they're going to buy it, So,
Yeah.
and that's from the broker's perspective. So, a good bit of, knowledge about the market that you're looking to invest in goes a really long way. Um, you know, so that's just, it was reminding me of it because Daryl and I were talking about markets a while back, I think. So
That's good.
yeah.
That's good advice. That's good advice. Anybody got any other questions?
Yeah, I have a quick question,
Sure.
Brady. I was thinking about whether you can learn much about doing a lot of multifamily real investing as an LP on a major project, as opposed to, jumping in to being a GP on your first project. Or do you find that it's quite passive and you don't actually see a lot of what happens behind the scenes on some of these projects if you just join as an LP?
I think it depends on the project you get in on. If you get in on, like a major, apartment building, and they're raising $5 million, and you're bringing in $50K, and they don't know your name. That's different than, and you'll still learn something from that. Don't get me wrong, but that's different than kind of coming along someone that you do know, that you've built a network with, and they happen to find a property before you. So that's what I did. Is I ended up partnering with someone that I knew from just my networking. They found a property. They were going to close on it. They still needed to raise some money, and I was like, okay, I'm going to partner with y'all. Now, granted, out of that, I'm not getting that high level experience that I would get, say, for a bigger property, more experienced sponsor. But because I know them, it does give me a closer connection to kind of behind the scenes. And, I think you've probably got to answer, is it worth it to do that first? I think investing as a passive investor in real estate is an awesome way to grow wealth. And I think, for some people, it's the right way to do it, to be honest. Being an active GP isn't, the end all, right? Certainly not. I mean, our goal, everyone's goal should be on the passive side, not the active.
That's true. That's true.
Even
Well,
the
too,
active
also
people.
another thing is too, is there's different thing you want to learn on which side of passive you can get the background, the back, pull the curtain back and see how a syndication works before you actually have to go out and do it, right? So the tools they use or don't use and how you would improve it. So when you offer to your people as a GP, that's what I learned to do it, is kind of say, okay, I'm going to take notes, and that's what I went into it with, right? What do they use? How do they present? What do they show at the things? Those kind of stuff you can do. Obviously, you're paying for that, right? But you're also paying for a coach. You're also paying to go to seminars and stuff. It's just another seminar. Now, it was a great question, James. I mean, that's just depending on what you will get something out of it. Not only will you earn money, but you'll learn the back end of the process as well.
Yeah, and there is some value, James, in knowing that gap between when someone gets something under contract to closing, and just if the people that you're investing with, and you can kind of get that behind the scenes look, or even regular updates,
Mm-hmm.
closes a lot of if you get something under contract and you're looking forward into this black hole of, of uncertainty, that's a lot different than, hey, I was a passive investor on this deal and this is what they did. Even closing that gap there's a lot of value there. So yeah, I would say there's definitely value on the front end if you can get that kind of update on what they're going through and so on. If you know the people, or even if you don't, you at least get some advantage from it.
Insight.
Great, thank
Brady,
you.
Brady, would you also say that some sponsors don't mind teaching? So for James, if he was with a sponsor that was in a teaching mode, that it would benefit him, so that whenever he does make that change to go into a GP, that he's even more equipped. So would you say that some sponsors are in the teaching mode and some are not?
Yeah. I don't have anyone that I'm closely tied to like that, but I do know of some other sponsors out there that, they make it their mission to educate their passive investors on what's going on, not just as a happenstance of, regular email updates, but as a purposeful education about, hey, we want you to understand, so yeah, I think it's finding those right connections. And that's why I say it probably depends, James, on your question on who you're really coming in as a passive investor with, and are they, planning to do that? I think someone that has a few properties under their belt's much more likely to do that than someone that has, 1,000, 6,000 units.
Yeah.
Yeah. But it's all, I go back to, to me, it's all about the relationships and building those relationships, and sitting across the table from someone and treating them like a person, whether they're a broker, an investor, a GP, and through that, you'll find the connections you need to learn what you need to learn.
Very good. Very good. Goodness. Awesome. Any other questions? Comments?
Can we go over the financial sheet that was up on the screen previously so I can get an understanding of the numbers? It would help me as an investor.
Sure. Was it this
What I
one?
wanna know is, where is
Or
the 200 grand coming from? Is it the second mortgage at 140, and where's the other 60 coming from?
So yeah, so that's a good question on here. So if we go kind of top to bottom, this is what they wanted, the asking price. Here's where we got it. It's price per unit. Earnest money deposit, that's what we put up to, at when we signed the contract with them, with the seller. You put this earnest money down, and then the down payment is on the loan, and then it shows two loans here. So the total loan amount was 1.4 million and change. This second mortgage here is for the capital improvement. But it's only, it's under that. Go ahead.
Well, no, I see repairs at 200 and then the second for 140. Where's the other 60K come from? 60K. Where's that come from?
So we raised that money. So this 140 is the bank is loaning us that money, and that covers 140 of the 200. And if you come further down, you have your closing costs, acquisition fees.
Yep.
This is the total repair cost, right? Some operating reserves, and then this total member capital needed to close is all of that combined. So whatever's not on the loan, but is needed to either cover closing costs, acquisition fee, or repairs or operating reserves. That's this number.
And then and then the investors off of the 774, your member equity and manager equity is part of that. So we'll just round it off. So 775,000 is the total amount of capital that we had to raise. Yep.
And out of that is, so to make it simple, I wish I had a dry erase board. To make it simple, the member equity at 75% is, we're assuming that member equity, that's the passive investor. Yeah. And the way that this is set up is that 775 is all being raised from that bucket, the LP, the limited partner side, if you will.
I see. So the
Now, that's not
75% is the 774. That's what the investor, we
I
would
see your
call
question.
passive investor would put in.
So I understand what you're saying. So we have to raise the total amount of 775,000, and the percentage of that number. So let's say I raised 100. Let's say I put in 100% of that amount. I put in the full 775,000 as a passive investor. Then what I would get in my pocket is 75% of the quarterly income distributions, and 75% of the equity when we go to sell the property. I would get all of that.
I see.
And then the managers would get 25% of the rest. Yeah.
Got it.
That's how you look at it. So if you're bringing in 50,000 of this 775,000, then you would get a proportional amount of that. Does that make sense?
Yes, it does. Now,
So this is a bit of a breakdown of that, if you will, showing how 50,000 would break out from the total capital.
Now, what is the normal period that these deals go? This one is showing 7 years. I've heard of with opportunity zones, 10 years. I've never invested in multifamily, and I'm just trying to get an overview. What is the normal? Is the normal 5 years, 4 years, 7 years, 10 years?
That's a good question. I think it depends.
Yeah, I mean, it has been 5 to 7 years typical in a syndication in our groups here. But with COVID, people are extending it 7 years because of the unknown. But it just depends, Buck, on which group you go with. I know some groups that they do 7 to 10, and they don't do anything less. So it just varies depending on the asset, depending on the returns, and their strategy and their business strategy. It really does. So
here's my problem in that I'm a mature person who's retired, and I don't want a 10-year return because I could be dead by then. You know what I'm saying? So I'm more into the the 4-year, the 5-year. And Brady, who decides that now? Is it the 7-year? You said you're going to look at it after 3 years, 4 years. Who makes the final decision on when to sell?
Yeah, so that would be the general partnership makes that final decision. So, but up front kind of what the business plan is. Yeah, I mean, everyone is, when you get, so for us, I mentioned this was our investor packet, so when we're ready to raise capital, or when we're ready to close on a deal, right, we've done enough due diligence that we know, okay, we're going to bring this to investors and bring it to close and not walk away from it. So we're going to bring it forward. By that point, the investors that, are out there will know this is the general outline of what we're expecting. They'll know, hey, we plan to hold it for 5 years. We plan returns to be at this number. We need to raise this much capital. They're not going to know all the details, but they'll get an upfront look. So as a passive investor, even before, the first kind of investor webinar, most people are going to send out kind of an informational email about, hey, here's some general idea of what we're doing and where this property is going to be. And there's most people that I see, Buck, are looking at 5 years. And with the expectation that if the market's really good, like it is right now, that they're going to shorten it. Yeah. I think the only reason people would lengthen it is if you're just at the bottom of the cycle. and which makes no sense for the investor or the general partnership to sell, right? If you have something like what happened in 2008, 2009, and you're making a profit, it's definitely not the time to sell, right? You want to wait that out. And that to me would be, that's why people would wait at the end of the day.
Well, in the real world, do the managers, let's say our managers are running the show here and they have another deal on the back burner with some other deal. Is it possible that they could actually sell because they have another deal and they want to cash out? Is that a possibility? Does that ever happen in the real world?
I'm sure it does. Go ahead, Earl.
Yeah, I've never had that happen. I mean,
Okay, I'm asking.
Each deal stands on its own. The reason they would sell a deal early, and again, this is just for us, not for Brady, but it would be that we've met the business plan way ahead of schedule, right? If this is what we're projecting, and they just bought this in March, and somebody comes to them at the end of this year and offers them exactly what they were looking for in 7 years, you'd be really a fool not to take it, right?
I
see. That's really, so if the business plan is met and we can get this person to the closing field, yeah, we're going to sell that thing, right away, because I've just shortened your time frame, right? I'm going to give you what we told you we're going to give you in 7 years or 5 years. I'm going to give it to you in 2 years.
Yeah. Yeah. And that's what I was going to say. I think in the end, I don't know. I don't have a tremendous amount of experience, obviously, but the people that I know, the reason they sell early is because they've met the business plan. I mean, generally speaking, people are going to try and hit their business plan, right? Otherwise, their reputation's not going to go very far.
Yeah.
And I mean, people aren't.
Pat, would you also say that in reference to what Buck is asking, his questions can be answered in the PPM, because the PPM is going to put in detail what the plan is, how long they plan on holding it. If they're able to hit their goal ahead of time, they are going to disposition that property so that all the investors will receive 100% of their principal plus the proceeds. So would you say that that information can also be found in the PPM?
Yes. Yeah. And that the PPM is the private placement memorandum, for people who don't know. And that's let's say the good, bad, and ugly of an investment. That's all the small print. But yes, it spells out exactly, hey, if we hit it here, we can sell. If we do this, we can sell. And that would, Buck, for you would be that, for everybody, would spell out exactly the ways that this won't go the duration of the business plan, right? If we run into this, this happens. So it's usually dictated out in there. That's good. Thank you, Daryl. I appreciate it. I forgot about that. That's a great way. And that is what you get after you say, okay, I'm in. You give a soft commit to this project, and then you would get that PPM back from the GPs, and you sign that document and say, okay, yep, I understand. Here's all and the PPM is basically, a lot of it is just, worst case scenario. If this happens, that happens. But again, they want you to be aware of worst case, right? So when you're signing up, this is what is going to happen.
Yeah. Yeah, the PPM is meant to scare you and inform you.
Yes, at the same time.
And it does a good job of both. But yeah.
Yeah. Does that answer your question, Buck? And that's a very good question. You had some very good questions.
No, I just want to know the numbers. I'm a numbers guy. Just want to understand. That's it.
No, that's good. That's good. I'm glad you're asking. That's what we're looking for here.
Yeah.
And I think this here, this is the profit and loss, right, for the property going out 7 years, right?
Yeah. So this is the profit and loss. This is the pro forma, if you will, going out 7 years of kind of the projection of how much income are we projecting, how much expenses are we projecting. It's of course tied to your capital improvement plan. When are you planning to finish that? For us, I mentioned it earlier, it's a bit extended. for us because we're going to finish our capital improvements in the first year. But we extended the improvement in rents by 3 years. Yeah, I mentioned that earlier. Normally it'd be closer, the bump in rent would be closer to the finishing of the capital improvement. For us, it was a mitigation to push it out because of COVID, but typically you would see that bump in rent closely tied to, maybe the year after you've finished most of your capital improvements. The other thing I think on the underwriting side that I encourage, passive investors to look at is also, we talk about this term called the cap rate, right? Which is just the capitalization rate, which is if you look at how much you bought something for versus the NOI, it's that ratio, right? And it's, especially these days where your interest rates are super low. Yeah, not to go into super detail, but your interest rates are really low for loans, which also is allowing people to push these capitalization rates really low. Yeah. So they're paying, in other words, they're paying a lot more money for the same net operating income compared to a few years ago. Yeah. Your guess is as good as mine as if that's sustainable and what happens if, or when I should say, interest rates on loans start to creep up over the next few years. Because inevitably that ratio between what you're going to get for leverage and what the capitalization rate is for the market are somehow closely tied together. Yeah. They're at least influenced by each other, right? And so I would encourage you, look to make sure people are increasing that capitalization rate over time. If it's 5.5% today in their underwriting, have they creeped it up to 6% or 6.5% over time? Because that is one of the biggest drivers in your prediction on when you sell the property as to where you think the market is when you sell. So in the numbers, you'll see it. Well, this is just an example of cap rates, but in the actual underwriting, when we go to sell, the way that it may not be shown in this example, but in general, it starts with the current market cap and then increments it 1/10 of a percent point over time. But, maybe that's too far in the weeds, but at the same time, as a passive investor, understanding what is the biggest driver for the number that I'm seeing on my return, it may be the cap rate. And understanding how the person has underwritten that and are they assuming it doesn't change, that's probably too big of a risk for me personally. It may not be for you. Everybody's got to make that judgment, but it is a significant driver on the back end assumption of how much equity you're going to get out of the property, if that makes any sense.
Oh, that does. And thank you for sharing that. That's very good information to know that and get the inside, scope of this so you can, as a passive or a GP, understand what you're getting into. Awesome. Did anybody else have any questions on the numbers or anything actually, but these, that we have the numbers up here.
I think Harrison just drew on my numbers.
Yeah. Somebody didn't like something there. Did somebody have a question where they were trying to circle something?
Here, see if it'll let me clear it. There we go.
Okay. All righty. Well, listen,
Cool.
Brady, this has been fantastic. Thank you very much for an hour and a half. I thank you very much. I appreciate that. I appreciate you spending an hour and a half with us. It's been very, very entertaining. And make sure that that you put your information in the chat, folks. And thank you very much, Brady, for coming on. And I learned a few things, which I always love doing. And I appreciate you coming on and spending your night with us. I know you have family, so I'll cut it off at an hour and a half. I appreciate that. And like I said, put your information in the chat. We'll get that chat log to you when I get the recording out. And thank you very much. And Thank you, Ken. I appreciate it as well. We'll see you in 2 weeks on our next one. And you guys have a good and great evening, and we'll talk to you in 2 weeks. Thank you, guys and gals.
Thank you, Pat.
Bye-bye now.
See you guys.
Thank you.